My name is Robert Stapler. I run a firm called Fintex Capital. We are an asset manager, an investment manager in the peer-to-peer lending space, but we're not a fund. We issue bonds to investors to give them what they want rather than a pooled exposure across various peer-to-peer assets. And we think that's a way of taking peer-to-peer lending mainstream as far as institutional investment is concerned.
Okay, Christian.
Good afternoon. Christian Fays, co-founder and CEO of LendInvest. We are a marketplace platform for mortgages. We're specifically focused on the short-term mortgage market. And in terms of our business model, we're very much a hybrid. So we have peer investors and a peer-to-peer sort of platform. And we have two funds that we manage, and also we have sort of SPVs with sort of separate bank funding lines. So we've sort of got a very diversified funding base for our lending activities.
Rory?
Thanks. Rory McHugh, responsible for specialist lenders and fintech solutions within the markets division of RBS, which principally revolves around products such as senior warehouse financing, rates and FX, risk management, capital markets, exit.
Hi, I'm David, COO, Managing Director of Smava, Germany's largest online marketplace lender. We, to some extent, also a hybrid, as Christian pointed out. We source liquidity from retail investors. That's what we started with. Also sourcing bank liquidity to bring that to consumers' unsecured loans. 150 people doing more than 60 million a month in loan volume.
Okay. Rory, I'm going to start with you because you've got quite a wide perspective here because you sit both on the bank side of the fence because you work for a bank, and you also work with platforms as well, and you work with institutions as well. Looking at it, where do you think the innovation is really going to come? Do you think it's going to come? Let's bring up a couple of things. Is it going to come in the structure of the offer? So that means, is it a fund? Is it securitization? Is it direct lines? Those kind of stuff. We've talked a lot about them today. Is that where the innovation is going to come? Is it going to come in the actual origination of it? Yeah, how technology can help originate stuff, because then that's a very interesting area, which we've not actually talked as much about in the main room as we have actually in the side rooms. They've been talking a lot more about origination in there. Or is it going to come from another area? Is it going to come from investors looking for different things within the spectrum? Is it going to become from actually people looking at this as part of a large alternative lending spectrum, and they'll just slot it into a general portfolio? I know I'm mixing kind of things, but you understand what I'm trying to get at. Where's the innovation going to come from, do you think, from your perspective?
Yeah, absolutely. It's a wide question.
Yeah, as I say. Yeah, I was about to say, yeah.
I think what we've all seen happen, and this is one part of I guess, a specialist lender, direct lending, market.
Yeah, certainly.
So much
alternative lending.
Changing within the wider lending arena. The bottom line here is that technology, the market circumstances, the unquenchable thirst for yield from investors in the current low interest rate environment, all sort of like combining to this perfect storm. Storm's maybe the wrong word, but a perfect opportunity for the
tailwind. It's giving you a tailwind.
And then the re-engineering of lending processes from front to back, right? So, on the origination side, all of the clever things that are going on in terms of partnerships, accessing new ways to originate product, getting closer to customers and unique sources of data, and using those sources of data in new and innovative ways is all happening all around us, and so many examples of that today. In the middle of the process, all the work going on to improve credit scoring models and use data right at the center. There's a lot of that happening as well. And then on the other side, you've got clear massive proliferation in product types reaching, the end investors. At some point, you almost think, is it time to stop the innovation a little bit? If you hear, the words of Andreas Wilgen and the rating agencies and people trying to do securitization, they'll actually tell you it's good to have a period of stability in your core business model. You certainly don't want to be tweaking your credit scoring all the time. And definitely the origination channels are
yeah, so
there's no doubt about the origination.
Yeah, let's get to brass tacks. Let's go through them. So origination, because I think we spend a lot of time talking about you securitize or put it in a fund, but that all presupposes you can originate the stuff in the first place. And that seems to me to be a real issue, which is actually it's all good and well you coming up with whatever structure you want to, but a lot of the platforms I talk to, a lot of investors go, well look, I've got £500 million I'd like to put in, I can't put the money in because frankly there's not enough origination. I know at least 2 investment banks who've looked at this area, got money ready to go in various bits of it. They just simply can't deploy it because the origination ain't there. And I hear a lot about that. I mean, what do we think? How are you going to crack this origination problem?
Well, I think it's a fairly broad question you're posing, but I think the origination side of things, so with us with mortgages, we're trying to bring technology to the process of applying for a mortgage, and we think that in itself is an innovation.
Yes, exactly.
There's certainly companies in the US that are more advanced with it, but we're bringing that here in the UK. So instead of having to go into a branch and fill out paperwork and hope and wait for 3 months, not at RBS of course, but at the sort of usual high street lender, it's just an extremely bad experience. So being able to do it online and to bring the whole process to make it a more smooth consumer experience, I think that's a really great innovation. And that hopefully will flow through to more deal flow, and then you'll have sort of more loans for institutional investors and retail investors to invest in. But
did you think though that it's going to come direct? Because it's not going to come intermediated. That's one of the kind of subjects that we all dance around, isn't it? Where is the origination? Is it going to come direct? Is it actually all in reality intermediated?
Well, for us specifically with mortgages, that's a tricky question. So the mortgage market is heavily intermediated.
Exactly.
So we have to build all of our technology to sort of cater to the intermediary market, because that's where our deal flow comes from as well, or sort of at least 75% of it. But ultimately, I do think people will go direct to platforms, and so ultimately, some years out, it's not inconceivable to see certain markets get disintermediated, which is ultimately a good thing. But in terms of the drive for deal flow, hopefully, there'll be different levels of innovation, and so I think it will be interesting to see how that goes. So you do say, like you say, I think ultimately there's probably more capital than there are transactions or loans to invest in. So does that then mean where there's innovation, where people create derivative type products?
Yes.
Where you can invest in a loan that is essentially a synthetic product which is linked to an underlying loan. I mean, it feels like if we go that far, we might be sort of rewatching a movie we've seen before, and maybe that's not the best way for things to go. So, that's...
David, what do you think about origination? I mean, do you think digital acquisition is effectively the way to go? Is that how you're going to have to crack the origination problem?
I mean, given our history, we're a consumer-facing brand. We are sourcing loans online. We are in this problem for years. We are 9 years in this market now, and we're sourcing online. So origination and customer acquisition is the key problem. To answer your broad questions, I'm less. We are less skeptical on the funding side, because again, banks are actually a good source of liquidity, and there's so many structured stuff now out there which helps you fund the loans. The key problem is really how to originate a borrower, and that's why most innovation, in my eyes, also like Christian said, has to happen on the borrower side. To do 2 things, to break it down to the main 2 things is price, which again is also a mechanism of course, liquidity in the marketplace. Bank liquidity is the cheapest cost of capital. If you combine that with the cost of operation that we have as a marketplace lender, the cheapest cost of operation, that drives down price for the borrower, which then is good for being a consumer brand which is successful because it has the cheapest price. So whenever you innovate on the pricing side and on the convenience side, and that is going into the direction, as Christian said, a more convenient loans instantly available online, then you can actually, I tend to say, you're able to beat intermediaries and become a direct go-to website. If not, I mean, that's the beauty of online. Offline, you have point of sale and intermediaries who lead the game. Online, you have at least a chance to have a converting product which is much more successful.
Yeah, I guess things like on the SME side, the manager portals, which are now coming in as well, all of these things are contributing to making to lead to more automation of the front end process and
but you said that, but on the SME side, I mean, it's interesting when you talk to a lot of SME orientated platforms, they still get most of their stuff by intermediaries.
Yeah, well, I mean, but the referral portals have only just been announced, right? So I mean, but I think the direction of travel.
Yes, it assumes the bank referral scheme properly happens.
Yeah.
I know it's supposed to happen, but it's just taken a while to get there. Robert, what do you think about origination? I mean, how are we going to crack this problem? Because I think everybody's agreed there's a great wall of money wanting to come in. No one seems to be, and obviously go visit Rory. Rory's got a great wall of money ready to come in as well. But it seems to be actually getting people to lend it to.
I think if we look back, there's been a ton of origination, a ton of innovation in the sector. And the fact that we're here is very much a proof of that.
Yes.
2006, 2007, this sector was born, and today it has become a big industry, especially on a global basis. There's 80 countries where there's peer-to-peer lending in every country. There's real estate, there's SME, there's consumers. You can subdivide it further. You know, Christian does a specific type of mortgages, and so I think there's been a ton of innovation, especially between, call it 2010, 2013. I think if the pace of innovation has ebbed off, I think we have seen too little genuinely new things. Not so much on the origination side, because I do think that the platforms are getting better and better at dissecting data and judging and assessing risk. But I think what we have to admit is that if we compare today's AltFi conference to last year, the sector has not really become mainstream as far as institutional investors are concerned.
No.
So I think there is a ton of innovation. It happens in small steps on the origination side. That's because the platforms are getting better and better, and we're looking at a lot of them, and we are always blown away by how they look at new information, how they analyze, and how they are intellectually accurate with whether this is noise or whether this is actual relevant, interesting, new social behavioral data. So we're very impressed, generally speaking, with the big platforms, and we only look at the big platforms. We're a bit worried because there's a ton of tiny platforms, and I hope they don't create a sort of a sector noise. But I think the real mainstream nature of the sector will happen if the industry gets better at delivering to institutional investors what they want.
What do they want? Is it just a scramble for yield? Do they just want yield? I know some quite successful wealth managers who just go, well, there's my fixed income portfolio, 40%, and it's yielding after fees, zip. Frankly, maybe after they 1 or 2% fees. So I'm going to stick it in alternative income and it's frankly, I just want 6%. Is that it?
I think that's the key point. The platforms are often looking for the entrepreneurial pension fund, and then they're surprised they can't find them, and that has to do with the fact that pension funds often aren't entrepreneurial.
I was about to say, entrepreneurial pension fund, that's by definition, that's...
Exactly. But I think you're touching on a very key point. In the alternative bucket, the returns are a bit higher, and the managers of alternative capital within large asset managers are prepared to deal with a bit of friction, with a bit of complexity as far as the due diligence and the investment process is concerned. If a platform wants to get a really low cost of capital, it needs to get into the fixed income bucket, and in the fixed income bucket, the guy needs to see a bond or a document and a format that his back office recognizes, etc. Yes. And you have also a currency problem. So if, for example, I wanted to invest in peer-to-peer platforms by going through a fund, in today's times where currencies are volatile, including Brexit, etc. noise, then the net return after the currency noise is not attractive enough for many buckets. So it's all about creating for individual asset managers what it is that they want, in the currency that they want, in the format that they want, in a format they understand, where their back office says, this is just another line item.
Christian, I want to pick up, so I was going to pick up, because you started, if I remember, I was getting there, Montello, wasn't it? Was your original, it was your original fund. And when you first started selling Montello to people, did they look at it and go, well, actually it's fixed income, so we'll stick it in the fixed income, or did they stick it in an alternative bucket? You see what I'm questioning?
Yeah.
Did you do that to answer to Robert's point, in the sense it made it easy, because you say to them here, it's a fund?
No, I mean, we started selling through the IFA route, so it was just a tough grind. That was sort of as UCITS was becoming a dirty word, and so we've sort of been on quite an interesting journey with that. But I think it's not just about the institutions. I think there's a lot of, everyone in the room here, we all know what peer-to-peer, and we think, it's it's a commonly understood thing, but I think the reality is it's not a mainstream product.
It's not.
And if you look at the figures, and we've done our own research, the number of people that are actually actively investing on these platforms is a really, really small percentage of the population. I think as we move into the ISA regime and we get it will move towards the mainstream over the next couple of years, but I think it's not just innovation with regards to institutions. I think there will be innovations at the retail level as well. So I saw an interesting presentation downstairs by LendInvest, where they're sort of talking about an aggregator where people can set up a single account and access multiple different platforms. I mean, I think something like that will be driven by a demand from an interest from retail investors wanting to invest in an ISA and wanting to do it in a relatively convenient way. So I think we're going to see lots of different levels of innovation over the next few years.
Rory, what's going to get, because at the moment, again, just picking up on echoing Christian's point, my impression is actually when I talk to a lot of institutional investors with my broader alternative investment hat on, is they don't really understand this space by and large. There are outliers who get it, and they tend to come out of the credit bucket, they're credit guys, and they sort of understand it, they get their heads around it. But by and large, if I went to the mainstream pension consultants, I'm pretty damn certain they would not be talking very much about this sector at all. Is that a fair, am I being a bit too cynical, or in your experience there is a little bit more knowledge out there? Sorry.
People are definitely looking at the space, right? So, I mean, I think there's no doubt about that. The fact that marketplace, alternative finance, and these types of topics are taking up increasing space at major industry conferences that are non-alternative finance. Like, I mean, I think I was just looking at the Barcelona ABS conference.
It's appearing in there, isn't it?
I think it's like 5 different panels.
It is actually,
which is quite amazing. I think it was one last year.
How about say 5,
before, right? So that really means, and I think the one last year was on the last day when everyone's normally in bed asleep and it was full, right? Like, so I have to admit I was in bed asleep and I heard that secondhand, but the fact is that it's nonetheless true, right? So people are definitely looking at it, from asset managers to pension funds to insurance. Also, it's so important to remember, that peer-to-peer marketplace is just one origination sort of capability or functionality within the sort of specialist lender sphere. Accessing these types of credit assets, there's so many different asset classes within that. If you look at, for example, mortgages, and sort of like 20, 30-year mortgages, in Holland, for example, people have started, generating them straight into funds and insurance. Pension funds are starting to look at that process there. In the UK, people are looking at similar. So I think
it's all part of a kind of an alternative lending and credit spectrum.
I think the idea of investing in assets which are originated by someone whose sole purpose was to originate them for somebody else and then service them for them is something that is arriving very quickly, and it's arriving.
And what's the one thing from your hat on what will really help boost that? Is it securitisation? Is it new fund structures? Is it bonds? What's the one thing that's going to help with that crowd?
Well, maturity, probably, more than anything. Maturity, data, performance history, stability in the space, and scale.
It's exactly what Andreas was talking about with the ratings, really, in the sense that you need all of that stuff for them to rate it. And until you have that will be a bit of an impediment for a lot of institutions to take up. What's your take? So how do you think you can reach to a wider audience, David? I mean, how are you going to get to this more institutional audience?
How are we going to attract institutional audience on the funding side, you mean? So I, of course, Rory and Robert are much more an expert in that field. I can only tell from my experience, and I agree to the fact that maturity, probably also standardization rate.
But you've got the maturity there. For instance, for something like you've been around for a while.
We do have. Maybe I tell one more thing to the question you asked before. I'm sometimes a bit. There's not something wrong with the understanding of the space. What I sometimes, and maybe that's the impression I have from the German market, which I now extrapolate to other markets, but what I think is sometimes wrong is the expectation in returns if you want to have a big scale. So if you want to, I would claim if you want to have a platform that reaches the mass market, returns are much smaller than what I always see on these nice little charts. So when I see UK return charts, it's that, for example, in Germany wouldn't be possible. If you want to have big scale and you want to attract institutional investors, you need big scale, you need the hundreds of millions that they can fund within a year or so, then the expectations which some institutional investors have, they wouldn't work, for example, in a market in Germany. And I would argue that's possibly also the case in the UK. So if
what do you mean they wouldn't get the same returns? So I mean, I can't remember what the Larry's at the moment, 6.4%. You're not going to get that in Germany.
No, you're not going to get that in Germany.
Any remotely near it? Remotely near it? Are you going to get 5%, 4%?
Rather in the 3 to 4%.
Okay, which is no.
So, and if you are funding AA, whatever class you want to call the borrower, and you're in consumer lending, it's even less than that.
Okay.
So, so that's why my answer is probably if return expectations, as maybe a matter of fact by maturity, trust, rating, return expectations go down, then this is going to help the at least in the consumer lending space.
Isn't that the truth, though, and Christy, that actually is, if the sector does show maturity, it may not show the returns it wants, and that may not be good news.
Well, I mean, one of the things that maturity brings is cheaper cost of funding as well, right? So, stability of returns, it all, but for sure, returns will come down on both sides, return expectations will come down.
Christian?
Yeah, no, I totally agree with Rory. I think that's already starting to happen. You get leverage coming into play and sort of cheaper capital, and that's good. I mean, certainly our business, when we set up in late 2008, our cost of capital was about 12% for our deal flow, and now that's trended down to sort of, around about 6 on a blended basis. So, it's dramatically decreased, and that's just purely a reflection of having a better data tape to show institutional investors and a longer track record and sort of more maturity, I guess. I'm maturing. It does lead to cheaper capital.
Well, but how are you guiding expectations with your investors at the moment?
Well, we're very much about horses for courses, and we recognize that peer-to-peer is not they're very different. So Zopa is very different to LendInvest. You can't really compare the two. And frankly, to throw them into one fund, which is one way of deploying capital, is very useful for some investors, but for others it is creating correlation between things that aren't really correlated. So if you think of a fund that invests like we do on the Aux Money platform in Germany into German consumer credits and also into Funding Circle, two very good platforms. They're both peer-to-peer, but if German unemployment rises, it won't affect the performance of SME loans. So what we like about being segmented the way we are is an investor can come to us and say, I like Aux Money, it gives me 5% German, long history, bankable, this is what I want to do. Can you do a euro-based compartment for me, issue bonds from that compartment, nothing else? And the same investor might 6 months later say, actually, the market that LendInvest is in is also quite interesting, very different market. Don't mix the two, issue me a separate piece of paper, and I think this is a way of innovating investing in peer-to-peer platforms by recognizing that whilst they originate in a similar fashion, the underlying exposures have nothing to do with each other.
Do we think that if you do that kind of proper structuring, this kind of innovative structuring, do you think that will make a difference? I suppose I'm still going, but I can't harp it back to my origination question. There's always a constant battle going on between expectations over here in terms of returns, origination over here in terms of what you can get in the door, and how you can structure it all together so you can make it work. Do you think that actually clever structuring, like you've talked about? So we talked earlier on about effectively structured products, sort of one step below private securitisation. And all sorts of other stuff. Do we think, and they're all part of a continuum, of which closed-end funds and funds are just another bit of it. Do we think they are really where the innovation needs to happen, or do we still think it's origination?
I do think that that's an important piece to the puzzle, particularly for smaller platforms that are going to take some time to get to sort of securitization scale, and it sort of fits a certain phase in the life cycle for sure.
But it's not going to make a big difference, is it, though? Because effectively you still need a lot more throughput, you need a lot more origination to be able to work your magic as an investment bank, to be able to make it work. You just need an awful lot more consumers out there taking consumer loans, SME loans, property loans out there. That's really the challenge for you, isn't it?
I mean, I think, from our perspective, we're definitely looking for scale in this space, for sure.
Okay, we've got the coffee break coming up. I'd like to say thank you very much to our panel.